Welcome, everyone. My name is Kristen Biermeyer, and I'm the marketing manager for Wegner CPAs, and I'll be helping to moderate today's webinar. I'm so happy to have you all join us today as we discuss the basics of accounting policies and procedures. During the presentation today, any questions can be submitted through the Q&A feature at the bottom of your screen. James will allow some time at the end of the webinar to address all the questions that have been submitted. The presentation is being recorded and it will be emailed to you after the event today. Our presenter is James Conrad. James is a supervisor in our accounting solutions group. He joined Wegner CPAs in 2020 after several years of working with Madison area nonprofits. James, with that, I'll turn things over to you.
Wonderful. Thank you, Kristen. And hello, everybody. Good afternoon. As Kristen mentioned, I'm James Conrad, supervisor here at Wegner CPAs, and today I'm going to be talking about the basics of accounting policies and procedures. I know that may sound like quite a dry topic for many of you, but they're very important for a number of reasons, which we will go over today. And hopefully you'll be able to see if you have any openings in your policies and procedures that need updates, or if you're going right along and have some good rules in place. So with Kristen's introduction, yes, I joined Wegner in 2020, November of 2020. And I've been doing nonprofit accounting as my specialty for about 8 years. Before that, I was a meteorologist by trade for about 8 years prior to that. So I'm very happy that I went from a job where I could kind of be right to one where I had to be right. I'm currently also the treasurer for the Verona Area Performing Arts Series here just in Verona, just outside of Madison, and also the vice chair of the leadership board at my church, the Church of Christ Memorial here in Fitchburg, Wisconsin. So I wanted to go over the learning objectives first. You may have seen those in the introductory email. First, we always have to start with the definition. What are policies and procedures? What do we need them for? And how are they going to be useful for us? If you already have policies and procedures in place, how good are they? Are they adequate? Are there flaws in them? We're going to be able to take a look at several policies today and see if they are working for you. We're going to take a look at policies and procedures that may be sufficient or deficient in your policy manual through examples that we have provided to us by some Wegner staff. And we're going to take a look at how your policies and procedures relate to any organizational audit that your company may be going through. I always like to loop back to audits because they have this big, they're known for being this big giant ordeal, and I want to demystify that for people as much as possible. So just a few things before we carry on. Today is meant to be an introduction. There's take everything I say as basics. If you have any specific questions that you need to run by an accounting professional or an auditor, make sure to do that. Basics will only get you so far, and a lot of policies and procedures need to be tailored to your organization. Along that line, we can't really cover every type of policy procedure, but we will be reviewing common ones, common policies and procedures that nearly every company should have, big, small, everywhere in between. And as Kristen said, I am planning to allow for Q&A time here at the end of the presentation as time allows. So, policies and procedures, who needs them? Spoiler alert, you and your company do. Every company should have robust policies and procedures in place for their accounting to prevent fraud and other bad things from happening, along with following the rules and regulations that are presented by both the accounting standards and government bodies. So, as I mentioned, every company, commercial or nonprofit. I personally work with nonprofit most of the time, commercial being the for-profit. Policies and procedures are good for everyone. So policies and procedures have kind of a three multifaceted purpose. An instruction booklet, as the name implies, with procedures, it's the how-to. If you're looking for how you should be performing certain activities, take a look at the policies and procedures. There's also internal company accounting rules. Much like not every company has the same policies and procedures. Not all companies have to follow the same rules. Some have more stringent, some have less stringent, and your policies and procedures should address that. And they're also acting in much the same way as protective guardrails. It keeps your books following certain rules and regulations to make sure that you can compare to other companies, you can relay information that is similarly presented at other companies to the general population, whoever may be using your accounting data. As I mentioned, each and every company will have different policies and procedures, and there isn't really a certain right way, but there are several wrong ways to do things, and we're going to take a look through that now. So beginning here, I have a comparison. So try to envision this in your mind. We're going to take a look and compare and contrast these two different companies, entities, what have you. So on one hand, we have a church. It's a small church, has 3 employees, and let's just say that it has $250,000 of annual revenue. The contributions that may come in, that's generally what I would be looking for in a small church. It's mainly funded by contributions, but there may be other sources like investments. And then on the other hand, we have a $100 million annual revenue manufacturing factory. So we're talking about a larger processing plant, something to that effect. How, in your mind, would those be different? So each entity is going to have their own but different challenges. Since the church has so few employees, there's a good chance that one employee is going to wear many hats. They're going to have many tasks that they need to complete on a daily basis just because there's a lack of manpower. The downside of that is that there's a higher chance of misappropriation, also known as stealing. So that's something that even churches, you're going to have to look out for. Churches tend to assume the best for people and the best of people, but that isn't always the case. The factory is got different challenges. Inventory. The church, other than maybe the communion wafers, isn't going to really have inventory, but there's also partially completed products, work in progress, and all of this expensive machinery that would be used to produce the product that they're making. If a newspaper printing press or lathes for woodworking, anything like that. All of these things are going to be treated differently at the different companies. However, both entities are going to have similar situations. How are bills paid? Every company is going to have bills to pay. When is a large purchase placed in fixed assets? We're going to specifically go over that today, talking about large purchases that, if you've heard of it, are depreciated, utilize depreciation. And then how are the books closed? On a monthly basis, quarterly basis, and then finally on an annual basis. Each company is going to have to close their books and have financial data readily available for their users. So policies and procedures are wide-ranging. Each and every one of these bullet points may be involved in your policies and procedures manual. You will likely see the cash policies, credit cards and expense reports, bank reconciliations and capitalization. But also if there is specific items that you have to deal with, such as a reserve policy, how much cash is available and on hand for use. There are many smaller nonprofits, especially, that go through cash crunches. They will be working on reimbursement contracts from various levels of government. And while they may have earned the money, they have not yet received it. So having a reserve gets them through those times. There's also external reporting standards. If you're audited, you're going to have external reports that are available for use for example, if you're nonprofit for funders, or if you're commercial, if you're a publicly traded company, you have to follow the Security and Exchange Commission rules and regulations. So as I mentioned before, the list is not all encompassing and there's not a one size fits all solution. It really depends on your company. And as your company changes, so have to the policies and procedures. As the company grows and scales up, you're going to have more employees, more items to depreciate, what have you, additional activities. And these policies and procedures will have to be updated as time goes on. So first, we're going to take a look at two basic policies, cash disbursements and cash receipts. And the reason I picked these is that every company is going to have to send money and take money in. Otherwise, you'll be going out of business pretty quick. So first, disbursement. And I'm going to provide an example that our wonderful Melody Bunting has made here at Wegner. First, cash disbursements. And I'm just going to read this and give you an idea of what this is a example policy and procedure that we have for one of our clients here, which I have the name blacked out. Positions authorized to sign checks are the business director, board president, and board treasurer. Only one signature is required on the checks. Anyone signing a check must review and initial the supporting invoice or other documentation. Individuals may not sign a check payable to themselves. An accountant will maintain the accounts payable system. Prior to payment, the accountant will code each invoice, prepare the checks, and organize the documentation. What's really nice about this procedure is that it specifically lays out positions such as business director, president, and treasurer, not necessarily the names of who is occupying those positions. So as staffing changes, you'll be able to keep this policy without having to update it for names. It also gives you the process, who signs the check, what has to happen when the check is signed. So the basic of the cash disbursement policy is how vendors are paid. How are you going to pay them when the time comes? So I'm mentioning some best practice items here. Who can sign the checks? This policy clearly dictates that the people that are authorized to sign checks are the business director, board president, and board treasurer. Some policies are going to have a dollar threshold with those people. Lower positions of authority may have a lower threshold of what they can sign, or you may need additional signatures for those larger dollar amounts. I've seen organizations that anything under $5,000 of the disbursement requires one signature, but anything 5,000 and above requires two. And then also in this case, the policy and procedure also dictates who prepares the materials for signers. The accountant will maintain the accounts payable system. And then we'll also prep the checks for signature and attach the invoice with them so they can be initialed. So this is a nice base cash disbursement process for companies to start with, and it would be tailored to your needs as time goes on. One thing I'd also like to mention during this time is third-party accounts payable and reimbursement systems. Most commonly in the accounting solutions group here at Wegner, we'll utilize Bill.com, Expensify, and Nexonia. Also in my past, I've used QuickBooks Bill Pay directly out of QuickBooks, and it's powered by Melio. What will help in these situations, utilizing these software platforms, is that it eliminates the manual check process. Instead of having manual signatures on the paper checks, it'll go through an approval workflow, which acts as signatures on the checks that are dispersed by the accounts payable company. These specific workflows would also appear as your policy and procedure. So let's look at some pitfalls that may be involved with your policies and procedures for cash disbursement. Petty cash or cash on hand. Who controls it? How often is it counted? Are receipts tracked? Often companies will have this cash box that just sits at the front desk. Somebody will take some cash out to buy stamps or some supplies at the store, not bring a receipt back. How do we know that was used for the right items? How do we know that somebody didn't just walk off with the cash? It's pretty unsecured, all things considered, even if it has a locked box. Who has access to it? Whoever has access, are they trustworthy that they can be in control of it? Also, checks without documentation. So if there's a purchase order system in place, think of the factory where you would likely have that. Is it attached? Is it with the documentation that needs to be signed? Is the purchase order signed in general by somebody of authority that has the authority to sign it? Is there an invoice attached to the payment stub? Systems I'll see is that the check stub, when the check is printed, you can take off 1/3 of the check stock and staple it to the invoice and the purchase order and what other paperwork would be involved. And then if there's third-party workflows, where there are edits made after the payment was submitted, that's something that you can change specifically in bill.com, that if a payment has already been initiated, there's no more edits that can be made to account or class or dollar amount as a specific safeguard against having check fraud. And one I will always call out for our accounts payable processors out there is, do you have a W-9 form on file for the vendors? When 1099 time comes in late December and January, instead of having to go hunt those down, I will always suggest to get one up front before you pay the vendor. That way, you know, if they need to get a 1099, you have their information on file. It will definitely help you avoid headaches when it comes to the filing deadline, which is the end of January. So all of these policies are meant to help against check fraud, theft, and embezzlement, really keeping your cash disbursements going where they need to go. So on the flip side, we have cash receipts. So I'm going to take a look at this basic one. All grants and projects are invoiced each month to ensure a healthy cash flow for the organization. Electronic or online giving should be encouraged to strengthen controls and reduce administrative time. Receipts not received electronically should be deposited weekly. So this policy will govern how your company gets paid. There are multiple ways that your company can get paid: cash, check, credit card, electronic funds transfer that goes directly into your bank. Some of those are more secure than others. So again, we'll look at best practice items. It may seem strange, but ask yourself, who opens the mail? If you receive cash at your company, either for bill payments for customer accounts or donations, if you're a nonprofit, is that person who's opening the mail being monitored? Are they out in the open where they could be seen opening the mail? And then with that, who assembles your bank deposit? Is it somebody that also opens the mail? What happens if you are paid in cash? Cash can be one of the easiest things to reappropriate to yourself if you're opening that cash from the mail. And then related to this, who reconciles the ledger balance to the bank statement? One of the best practices out there is that the person performing the bank reconciliation should have no influence on either the receipt or the dispersal of funds. That way they are acting more as a neutral party in the process. And then for those places that have maybe an ERP, or if you're a nonprofit, a donor software that tracks your donors, is there a separate system that requires reconciliation between the customer balances in the accounting ledger versus the customer balances in this third-party system. Frequently, if those two systems don't talk to each other, you have to reach a balance where you know it is correct and it is correct on both sides of the equation. And nonprofits, another one for you. Are you sending your donor acknowledgement letters? A good way to not have donors in the future is A, not send one when they're eligible for a letter, and sending it promptly. Sending it promptly is a very good practice to have. It acknowledges that you received their donation and that donation was important to your company. So important that you wanted to talk to them and say thank you right away. And a little fun fact here, you see the $2 bill on the screen. If you're not aware, the $2 bill is real and it is still being produced. I love getting $2 bills. It's just one of those strange things that I like. So again, looking at pitfalls. If a single person opens the mail, collects the payments, and creates a deposit, and then takes it to the bank, think of all the possible times that deposit could be skimmed. Back to the church example. If there's only one administrative employee that performs all of these tasks, they could easily start causing problems and skimming off the top of your deposits. It's really easy to slip that $20 bill in your pocket when nobody's looking. If somebody is looking, if there's less of a chance of that occurring. And as I mentioned before, the same person should not be able to reconcile the bank account that collects the funds, because that person could skim the funds and then reconcile the account and no one will be the wiser. So these policies safeguard against fraud, external theft, and internal embezzlement. External theft being from somebody outside of the company, internal embezzlement, somebody that's on staff and is skimming off the top. So the most important concept I wanted to go over today is the idea of internal controls. Policies and procedures really strengthen and dictate your internal controls. So internal controls are rules and regulations put in place in an organization that mitigate risk, promote ethical conduct, and ensure management decisions are being carried out. Ethics is your internal portion of people knowing what to do and especially what not to do. Mitigating risk is making sure those people can't do the wrong things that they may want to do. And ensure management decisions. Are tasks being performed the way management would like them to be performed? Or are people just doing things the way they want to? And is that causing issues for your company? So we want to make sure we're finding problems as we go along. If something just doesn't seem right, are your processes and procedures with your internal controls causing you to find out about that? They will have formal rules, what's written down on the paper, but then also they'll have this intangible, informal tone and trust. Does management have a certain tone that they want? Is this something that's very important to them that they want followed? And then you can have manual processes and automated processes with your internal controls as well. Of course, much like an audit is not always going to find fraud, internal controls are not perfect. Fraud and errors can and will occur. Errors just happen. We're all human. We're all going to make mistakes. Nobody's perfect, if you will. You can have the best controls out there and you may still have issues. And as I mentioned before, much like policies and procedures on the individual basis, not all companies are going to have the same internal controls. Different levels of staffing, for example, will dictate who does what. So I wanted to go over some common internal controls that we regularly see. First, a really good one, the separation, also known as the segregation of duties. So having multiple people that not only know how to do the process, but certain tasks are done by different people. So this helps avoid no single person being able to control cash receipts, for example, from start to finish. It really helps eliminate the skimming off of the top. The multiple sets of eyes example. If you're so much less likely to take that $20 bill and slip it in your pocket if your colleague is looking right over your shoulder and can see you doing it. It's pretty obvious. So, for example, opening the mail, whoever opens the mail, they may not necessarily assemble the deposit. They can log what came in, but someone should verify that log, that the log is correct and they have all of the cash that's there. But that same person that is assembling the deposit isn't going to open the mail. And then physical security, it's pretty common sense here. If you have cash on hand or you received a lot of cash but weren't able to take it to the bank, do you have it in a safe? Church congregations will take their Sunday offering. They don't necessarily take it to the bank right away, but they have a safe, goes right in the safe, and they take it in on Monday when the staff is in. Or conversely, if the bank is open, take it right to the bank after the deposit is logged and assembled. Take it in one of those locked zipper bags. I'll often see that, or have a courier service. And then locking up valuable equipment, just making sure that things are bolted down or things that you want to stay there can stay there. Also really important are the reconciliation process. Having a third party involved where you have a bank or an external accountant that verifies your transactions, make sure that when you do your check, basically like balancing your checkbook when you're reconciling to your check account, does the deposit that hit the bank match what they have in the logs? Or did somebody open the bag and take something out? The reconciliation process is a really great tool to be able to find those discrepancies. So we're going to head back to the example of the church and the factory. First, here's some things that the church can do to be successful. So with your safe, it requires 2 different keys to open. There are safes out there that you'll have 2 different keys with 2 different lock patterns in the key. One will be given to person A, one will be given to B, and they can't open the safe unless they're both there. That ensures that 2 people have their 2 sets of eyes on the process. The offering is counted with multiple people. For example, the office administrator and one of the clergy, just 2 different people involved in the process. And then the church may have an outsourced accountant. They can reconcile and prepare financial statements, but they're not involved in any of the operational procedures to pay bills or to take in deposits. And then finally, many churches will have some sort of donor database where it tracks how much people have given, and then also who has received the donor acknowledgements. Churches will often send out quarterly statements of people who have donated. And then also the final roundup at the end of the year that can be used on taxes. So for the factory, let's take a look at some items that they can do. So payments from customers arrive by a check. No cash is handled. You can just say we don't take cash, and hopefully that would mitigate having any cash balances on your premises at all. Or even better, direct deposit into the bank. You can have it where they can do their EFT or ACH process, goes right to the bank, and there's nobody else involved in the process, sitting there safe in the bank. Purchase order systems, everything approved by management, somebody with authority that says, yes, we want to buy these materials, this item that will help us perform our duties. But making sure that if there's violations to that process, that there's disciplinary action. It's one thing to have a process, but is there a consequence for violating it? Tools and fixtures. If you have items like computers, for example, or the heavy machinery? Do you have a tagging program? Are they logged into a fixed asset program, some sort of asset program that can track, okay, we have S232 item here. Oh, that's the computer in Joe's office, something like that. Rotating passwords is another one that is easy. Nobody likes changing their passwords, and so many of us have one password for all of our accounts. I'm going to look in a mirror on that one where I need to rotate my passwords more often. But if you have your accounting software that's local on a local database or your ERP system, change out the passwords on those computers. So people that may have come across the password inappropriately can't access your system. So, excuse me. Here's some tips for your own internal controls analysis. How often are they reviewed and updated? The accounting manual may be collecting dust in some drawer in the accountant's office for the last 5 years, and no one's taken a look at it or needs even scanned it for an electronic version. It should be reviewed and updated much more frequently than that. The responsibilities of various people, especially management and the board of directors, who have the fiduciary responsibility of the company in many cases. What roles do they play in these processes? Is there an audit that's necessary, either by law? Wisconsin, for example, has a law where if you have a certain amount of contributions each year, you're required to have an independent accountant perform a review or an audit. Or is there a board directive that requires every 3 years you may need to get an external audit? Who can make decisions? Make sure that power is vested appropriately. There may be, for example, the CEO, CFO, controller, various managers who can make those decisions for purchases, disbursements, and just the overall direction of the company. So this is a think about it moment. If you have too much authority in one person, how can you spread it out? Spreading out that authority will help mitigate risk and making sure that no single person can just violate the rules. So now we're going to kind of just do a little exploration of more policies that are basic in principle and will get your accounting manual on the right foot. Another core concept to think of is the basis of accounting. Many companies aren't utilizing the same process, or excuse me, same basis across the board. So I want to introduce the two main here are the cash basis and the accrual basis. So when we talk about the cash basis, it's all about when the money is either sent or received. So revenue is when you receive payment for services or products, and expenses are about when you send the check off to the vendor in question. It's all about the cash, but the accrual basis is all about earning or owing. So, for example, if you render services and you give somebody an invoice, that's money you've earned but not yet received, accounts receivable, if you will. Conversely, with expenses, you've received services for fixing your furnace, something to that effect, and you choose bill me later. Well, you owe that money. It's an expense right now. You owe it, and that's accounts payable. Cash does not need to change hands for revenue and expenses to occur. For many companies, you're going to be on the accrual basis. That is what is used for the generally accepted accounting principles, or GAAP, if you've heard of GAAP, in America. Internal use statements can be different, and many times often are. It's whatever is important for the end user. So if your manager wants to see your financials on a cash basis, they're more than welcome to have cash basis internal reports. But if there's external users, frequently they have to follow the GAAP rules, which will involve accrual basis. And what complicates factors even more is that taxes have their own kind of basis, basically. There's so many different rules about what affects how much income tax that you owe, such as taking large purchases and just making them expenses, or any number of things for tax credits. Taxes are going to not fit neatly in either of those. So a manager may want to see how it's going to affect income taxes. The capitalization policy. I have another example here, property and equipment. So if you've heard of PP&E, property, plant, and equipment, this is the capitalization policy. This example had a threshold of $3,000. Its property and equipment are recorded at cost or the dominated fair market value, and they use the straight line method of depreciation. So when is an expense not an expense? When the expense is capitalized. So we're talking large purchases. In this company's example, it's $3,000. For other companies, it's going to be $10,000. For the Pentagon, it could be $3.5 billion for all we know. It all scales to the company in question and the size of the company. So property and equipment may be subject to the capitalization policy, and then it is depreciated or also amortized. So generally a dollar amount will be used, in this case, the 3,000, either as a single purchase, or let's just say you bought a lot of computers. Each individual computer may be under that $3,000 limit, but on aggregate, as part of your order, you have enough to get to that $3,000. You're going to capitalize that group in a really short period of time. And there's no set time limit for that. It's something that has to be analyzed for a reasonable amount of time. So if you're under the 3,000, this expense goes right on your profit and loss statement or your statement of activities for nonprofit. If it's over that amount, capitalize it. So the purpose of this is to, more accurately reflect the use of that item over a period of time. If you expense it, that's basically taking all the expense and putting it in 1 year. You're basically going to use it up over the course of that fiscal year. But if you capitalize it, you're expecting to use it over a course of multiple years, 3 years, 5 years, 10, what have you. And the depreciation is what gets that expense into the later periods. I don't want to get too deep into depreciation. That's a topic for another day. But that's the idea behind it, getting the expenses in the appropriate time periods. As I mentioned, the differences between nonprofit and commercial companies, they may have vastly different policies. One of the things that especially affects commercial is income tax. The income tax for nonprofits is generally next to nothing, depending on what activities they're performing. So nonprofits will have a simpler policy, much like we have an example here, but the commercial company may have a very robust policy since they have so much expensive machinery, or if they have depreciation that's related to, or expensing related to income taxes. There's a lot of different acceptable methods for depreciation. Nonprofits will also often keep the simplest one, and that is the straight line depreciation. As I mentioned before, bank reconciliations are nice, are a really important part of the process for finding things. So why? It cuts off cash flow problems at the pass. Your bank statement may say you have $100,000, but if you have $90,000 of outstanding checks, you don't have $100,000, you have $10,000. You can identify stale checks. So the checks that have been sitting there, nobody's cashed it yet. It's a year later, the check really should have expired already. You can find out, hey, what's going on with this payment? Did it get lost in the mail? You can find duplicate deposits. Imagine that whoever is entering the deposits into the accounting system, they just happen to put a second one in, and your balance looks higher on your ledger, but nothing hit the bank. it's important to find those. And then bank errors, they do happen. You have a bank error in your favor in Monopoly for $200. Odds are you're probably not going to keep that $200. So reconciliations should be frequent, at minimum monthly, but some organizations do reconciliations daily because of their cash flow issues. Companies will utilize lines of credit to get them through those times, or they'll withhold paying certain bills. So as a reminder, we kind of went over this before. Anyone with the authority to write checks or make bank transactions, such as ACH out, electronic payment, should not perform the reconciliation. It makes it easy to kind of gum up the works, make it fuzzy about who is getting paid what and when. And then an authorized person should review and sign the reconciliation with some backup data that can be brought along with it. These procedures should be found in your monthly and annual close policies as well. Here we are, closing the books. So closing the books is finalizing the data that is appearing by month, quarter, year, and then the financial statements that are generated behind it, done on a regular basis. Management certainly review these reports, and then for nonprofits especially, the boards are going to review them, and often as part of their procedures at the board level will take a vote and approve them. As I mentioned before, monthly and quarterly for the interim closes are the most common. And then also a treasurer and a manager with financial knowledge should review, because the board will also have questions about what's going on. Many times the board members don't have as much financial acumen as the accountants themselves or what have you. There will be boards that have CPAs, finance people on it, but the accounting crew should be able to answer the questions that the board is presenting. Now it's audit time. Now what? Don't be worried about it. You can get through it. So it's important to keep in mind that an audit isn't just about the numbers. They're going to look at policies and procedures. They're going to look at the accuracy of your financial statements, but they will also look at the risk and internal controls that you have in place. There's the fraud inquiry. Are you aware of any fraud? I've always, when I'm on the receiving end of an audit, receiving that question, like, no, the answer should be no. Significant estimates. For example, if you have multiple funders as a nonprofit, how are you allocating or splitting up the expenses that are given to each of the funders? There's walkthroughs. So an auditor will monitor how a specific process takes place to make sure that the rules are being followed and the rules are adequate enough. And then sample testing. Anybody that's been through an audit for accounts receivable and accounts payable, when you actually have to pull out the deposits, or you have to pull out the check stubs and the invoices that are attached to them, that's making sure that the processes are being followed. And then one final one here is the idea of going concern. You'll see on some audit reports that the auditors are concerned that the company is going to go out of business. So they're going to check if that's true. Is the company in dire straits that the users of the financials need to know that there's a problem? So testing will look at your policies and procedures. How recently have they been updated? As I mentioned, the dusty accounting book that hasn't been touched for 5 years. It might be time to update. Are your policies, procedures, internal controls robust, and they mitigate the risk to acceptable levels? Acceptable being the key word, because you can never eliminate the risk of fraud. It's just fact of life. Two ideas to look at are significant deficiency and material weakness. A significant deficiency is something that merits attention. It's not severe necessarily, but it's kind of a hole in your policy or procedure. It makes you aware that there's something to be patched up. But a material weakness is more severe and requires immediate correction, to the point where certain material weaknesses will affect funding from certain funders. So having those deficiencies and weaknesses really can reflect poorly on your company. If there's word that you don't handle your money well, and you don't handle paying your bills well, it's going to give second thoughts to the people who use your company. Donors, if you were going to donate to a company, do you want to donate to a company that doesn't handle their money correctly? No way. There's just the idea of sloppiness. And then, of course, as I mentioned before, publicly traded companies have to follow very specific rules. In this case, the Securities Exchange Commission. And that can severely affect the company. So we're quickly approaching the end here. So in review, just kind of rounding things up. The policies and procedures are your roadmap and your guardrails for accounting related activities. They are not one size fits all, and their adequacy really depends on the size of the company, the type of the company, and other factors. You should have your adequate internal controls to mitigate your risk of fraud and errors. And auditors will help, will review and analyze your process and procedures to make sure they're up to date and they're robust and they're being performed as they are stated. And with that, we have arrived at the question and answer portion of the presentation. So I'm going to open my Q&A window. All right. So first up, we have a question from Jackie Montgomery. What's some good language to allow for electronic payments out? And think of some wording. So much like manual payments out, there's the check signature. You could also have a listing of electronic payments that are going to be sent out, initiated by someone that's a little bit outside of the process that has the authority to do that, the check signer. A listing of those that the check signer would also sign that you can keep for your records going forward. It's not perfect. It doesn't have the check stub, but you can easily track payment A, B, C on the bank statement of the related day. You can go back, say, okay, here's what the CEO signed saying these payments should go out, and here's the payments going out. It has that process of the sign off, the multiple sets of eyes. Olivia Williams asks, what's the payment threshold to require a W-9 and 1099? So there's multiple levels, but the most common is what you're going to have for contractors and basically the independent contractors in the world. And that is $600 of aggregate payments, not one single. So if you pay $600 over the course of the year, that independent contractor should receive a 1099 when it comes to the filing deadline, which is the end of January of the next year. So for this year, 2022, those 1099s should be submitted to the IRS and out to the contractors by the end of January 23. And then related to that, Kathleen Brady asks, are there any simple rules of thumb for when you need a W-9? The simple rule of thumb would be you always request one from anybody that you're going to pay. However, often you'll know from companies that they just don't need one. Corporations don't need a 1099. Government entities do not need one. Excuse me. There's lower thresholds for royalties. Not many companies deal with royalties. The threshold for that is only $10, I believe. I don't deal with that one very frequently, but I know it's a much lower threshold. So can't go wrong with always needing a W-9. One kind of loophole in the situation is if you pay by credit card. If you pay a vendor by credit card, you don't send the 1099, the credit card processor does. So if there's somebody you're not quite sure about, you could pay them by credit card and not have to worry about it. So it's just that kind of, that one trick that doctors hate, so to speak. So that is the question so far. If you have any others, I'll be here for another couple of minutes if you have any. Otherwise, that concludes my presentation for today. I want to thank you for coming out, hopefully learning something, and go back and take these ideas and see if you need to patch things up in your company.
Thank you, James, for sharing your expertise, and thank you everybody for joining us today. We hope you found this presentation helpful. Just a reminder that we have some more great trainings coming up for nonprofits, including a QuickBooks users group this Thursday. And then we also have a couple spots left in our certified nonprofit accounting professional course that's beginning next week, Thursday. And then at the end of October, we'll be starting our nonprofit leadership series, and that consists of 3 webinars where we will be exploring the vital leadership roles and responsibilities of nonprofit governance. So you can find details for all of these webinars on our website at wegnercpas.com. We hope to see you at one of these events again soon.
And I just received a late question about the PowerPoint. Yes, I will get that out to Kristen, so it is available for use later on.
And Rosetta, yes, the recording will also be available, and I'll send that with James's PowerPoint.
All right, everyone, we're going to do a last call for questions. So if you have anything, I'm ready to answer.
That looks like it's all we've got for now, James. So I'll close this out. If anybody still on the line has questions they think of after this, I'll be sure to include James' contact information in the follow-up email as well. Perfect. All right. Thanks,
Send
everybody.
those questions along. Thank you much, everybody. Have a good day.